Hi everyone, welcome back to Saheb Academy. Today in the sixth video of Internal Reconstruction chapter, we're going to solve our fourth problem, which is illustration 4 from the ICAI study material. So let's start. Let's first just go through the question fast, and then one by one we'll pass the journal entries, and then we'll see the balance sheet after the reconstruction. Okay, so let's begin. See here, illustration 4. Given below is the balance sheet of Rebuilt Limited as at 31st March 2021. So here we have the balance sheet. As you can see, share capital, reserves and surplus, long-term borrowings, trade payables, other current liabilities, and then in assets, non-current assets, PPE, intangible assets, inventories, and trade receivables, right? So in share capital, just have a glance properly. Here we have 15,000 equity shares of rupees 50 each. All right, that's the face value. Preference share capital, we have 12,000 cumulative preference shares, 7% of rupees 50 each. Preference dividend is in arrears for 5 years. You see in the bracket it is given over here. So you have to understand there must be an adjustment regarding this. Either maybe we'll pay this or it will be waived off. Okay, or maybe we will issue shares in regarding of this. Okay, fine. And then see reserves and surplus, debit balance of profit and loss, which we have to write off at the end in the big entry, you all know, by utilizing the capital reduction balance. Fine. And then long-term borrowings, here we have loan, and then there are no debentures and all, just loan. Okay, fine. PPE, building at cost less depreciation, plant at cost less depreciation, fine. And then in intangible assets, here we have trademarks and goodwill at cost, 3,18,000, fine. So what are we going to do is, let's just see the requirement first, and then we'll just do pass the journal entries one by one just by looking at the adjustment, right? So see here, the company is not earning profits, it is short of working capital, and a scheme of reconstruction has been approved by both the classes of shareholders. A summary of the scheme is as follows. So many adjustments are there, the entire scheme of reconstruction. And then let's just see the requirement. See here, show by the journal entries how the financial books are affected by the scheme and prepare the balance sheet of the company. We have to prepare the balance sheet after the reconstruction of the company. After the reconstruction, the nominal capital as reduced is to be increased to 6,50,000 for preference share capital and 7,50,000 for equity share capital. Now you all know, there will not be any entry to increase the authorized capital. The nominal capital means authorized capital. So here they are just saying that we have to increase the authorized capital. So that's just disclosure that we will do in the notes to accounts. That's all. Okay, there will be no entry and all for this. Fine, we'll see, don't worry, it's really simple. Okay, let's start. Let's just go to the solution and pass the journal entries one by one. Now see here, we have the solution. In the books of Rebuilt Limited, we have to pass the journal entries one by one by looking at the adjustments. So let's start with the first one. See A, the equity shareholders have agreed that their rupees 50 shares should be reduced to rupees 2.5 by cancellation of 47.5 per share. So from this first sentence, you can easily understand here they are talking about what? Reduction in the face value. Rupees 50 share is being converted into rupees 2.5 share. Okay, the face value. So such a huge reduction is there over here of 47.5 per share, but it doesn't matter. The question is saying that, so we just have to follow and reduce the face value. Okay, so let's just pass the journal entry for this, and you all know the technique now, how to reduce the face value. Just cancel the old capital with the old face value and create the new capital with the new face value. Okay, and then whatever is the difference, that will go to capital reduction account. Fine. Yes. So now how do you cancel the old capital? Just by debiting it, isn't it? How do you kill the equity, the capital? Just by debiting it. That's what you do. And how will you create the new capital? By crediting it. Fine. That's how simple it is. So let's see. Equity share capital account, debit 7,50,000. How did I get the 7,50,000, this old capital? It's really simple now. Just look in the balance sheet. Here it is there, 7,50,000, the old equity share capital. Just debit and cancel it all, and then credit the new capital with the new face value. The number of shares have not changed now. The number of shares are 15,000 only. So 15,000 into not 50 rupees, 2.5, the new face value. So 15,000 into 2.5, that's equal to 37,500. See, 15,000 into 2.5, that's equal to 37,500. Okay, so this will be credited, new capital is created, and then the balancing figure will go to capital reduction account as the gain. How will you calculate that? 37,500 minus the old capital 7,50,000. That will give you the amount that will go into the capital reduction, 7,12,500. Simple, easy. And then in the same adjustment, there is one more sentence. Let's just read that. See here, they have also agreed to subscribe for 3 new equity shares of rupees 2.5 each for each equity share held. Now here in this sentence, they are talking about right issue. What does right issue mean? It means that, new shares are being given to the existing shareholders in the in certain ratio. Okay, so here as you can see, the shares have been issued to the existing shareholders. Yeah, they have also agreed to subscribe for 3 new equity shares of rupees 2.5 each. 3 new equity shares for each equity share held. So by this sentence you can understand the ratio also. 3 for everyone. Yeah, 3 for everyone. So that's the ratio. Now let's just see how to calculate this. It's really simple. See here, 15,000 shares were there, existing shares, right? So 15,000 existing equity shares into, take the ratio, 3 by 1. Yeah, 3 divided by 1. 3 for everyone now. So that's equal to 45,000 new shares will be given to existing shareholders. Okay, and the price is 2.5, the face value only, into 2.5. So that's equal to 1,12,500. So what happens in right issue? In right issue, it's not free. We will receive the money, right? So this money we will receive 1,12,500 and new capital will be created. Fine. So see the journal entry. It's really simple. Bank account debit to equity share capital. Okay, just fresh issue entry. 1,12,500, 1,12,500. And I just explained you the calculation also. Existing equity shares which you will get from the balance sheet, yeah, into 3 by 1, the ratio, the right ratio, that's equal to 45,000 new shares into the price 2.5, that's equal to 1,12,500. Simple. Okay, fine. Moving on then to the second adjustment. See here, the preference shareholders have agreed to cancel the arrears of dividends. Stop right here. Let's understand this. You all know that previously we saw, there were preference dividend in arrears for 5 years, right? See here. So let's just calculate this, how much it is. The preference share capital is 6 lakhs, yeah, the face value, into the 7%, right? The dividend is 7%, so into 0.07, that's equal to 42,000. This is the annual dividend, into 5, because the dividend is in arrears for 5 years, so that's equal to 2,10,000. Yeah, 2,10,000. So do we have to pass any entry regarding this? Now what's happening over here? Cancellation of arrears of dividend means we don't have to pay the dividend. The preference shareholders have foregone the dividend. The dividend has been waived off. The arrears have been waived off. Yeah, we don't have to pay this. So do we have to pass any entry regarding this cancellation of arrears of dividend? Do we? Of course not. We are not going to pass any entry regarding this cancellation. Why? Why is that so? Is it not gain for us? To understand, we are not going to pass the entry because there are no liability or any payable in the balance sheet over here regarding this 2,10,000. Can you see 2,10,000 over here? Anything regarding preference dividend in arrears? No. So that's why we can't pass any entry regarding this and take the balance to capital reduction. Is that clear? That's the logic. Fine. So what we have to do then? We have to completely ignore it. Okay, just ignore that first sentence. Fine. And do not disclose it further in the balance sheet or in the notes to accounts, yeah, or in the in the extra disclosure. Okay, see here, the preference shareholders have agreed to cancel the arrears of dividend. Just ignore that. And to accept, now see, there is something else also, and to accept for each rupees 50 share 4 new 5% preference shares of rupees 10 each, plus 6 new equity shares of rupees 2.5 each, all credited as fully paid. Now what does this mean? What's happening over here? We didn't understand anything, you will say. See, it's really simple. What they are doing over here is the company is cancelling the preference share capital also. This preference share capital, now this 6 lakh, this is also being cancelled. Understand, 12,000 into 50, that's 6 lakh. So this 6 lakh is also being cancelled, and in replacement of this, what they are giving, the company is giving new 5% preference shares in the ratio of 4:1. Guess that now, 4 new 5% preference shares for each 50 share. So what's the ratio? How they are giving the new preference shares? in the ratio of 4:1. You have to understand this. It's really simple. It's not difficult. And the face value is rupees 10 each. Okay. Plus, that's not all. Plus 6 new equity shares of rupees 2.50 each. Yeah. 6 new equity shares. So the ratio is 6 for every one. 6 for every one. Yeah. 6 for each 50 share. Is that clear? 50 rupees share. Yeah. For each share actually. So that's the ratio. So now how will you calculate? And what does this mean? All credited as fully paid. What does this mean? It means that the company will not receive any money regarding this. It's just replacement, cancellation of old preference shares, yeah, old preference share capital, and giving this new preference shares and new equity shares. Yeah, that's the meaning of that sentence. So let's just see how it will be calculated. It's really simple. See here, let me just show you. 12,000 were the old preference shares, right? So these are being replaced now, right? So how will you calculate? It's really simple. See here, 12,000 into 4 new preference shares for each old share, right? So 4 divided by 1. So that's equal to 48,000 new preference shares will be given. Okay. And then if you want to calculate regarding new equity shares, which will be given is 6 for every one, right? 6 new equity shares for every old share. So 12,000 old preference shares into 6 divided by 1, 6 for every one. So that's equal to 72,000 new equity shares will be given to preference shareholders. Okay, do you understand the logic? I want you to understand the technical language over here. Passing the journal entries and doing all the presentation and everything is very simple. Only if you understand the technical language over here. Okay, that's why I'm giving so much importance in this. All right. Okay, fine. So let's just see the journal entry now. Yeah, so see here, what are you going to do? You are going to first debit the old preference share capital and cancel it. I told you now. See, they have mentioned over here, and to accept for each rupees 50 share. So that 50 rupees share now, the old is being cancelled and new things are given to them, right? New shares are given to them. So that's why you have to cancel the old capital by debiting it. You all know that's how you cancel the capitals. 6 lakh, it's there in the balance sheet, and then you will give the new capitals, yeah, the new shares, to 5% preference share capital account credit, to equity share capital account credit. Okay, rupees 10, rupees 2.5. You will get this in the adjustment only. See here, preference share rupees 10 face value and equity share rupees 2.5. Okay, fine. And the amount, how will you get the amount? You have calculated now. See, 12,000 were the old preference shares into 4 divided by 1, right? I'm talking about the new preference shares. 12,000 old preference shares into 4 divided by 1. Yeah, 4 for every one. So that's equal to 48,000 new 5% preference shares into face value rupees 10. That's equal to 4,80,000. Is that clear? Simple. And then regarding equity shares, we saw now 72,000 new shares were issued, right? 12,000 old preference shares into 6 for every one. The ratio 72,000 new equity shares are given at what price? At 2.5. So that's equal to 1,80,000, right? So 4,80,000, 1,80,000. That's how it came, right? Okay. Now just add 480 plus 180. That's equal to 6,60,000. Now understand properly what is happening. From the company's point of view, understand the company has given 6,60,000 of capital to preference shareholders, right? 6,60,000, and it has cancelled how much? The company has cancelled 6 lakh. So the company is bearing a loss of how much? Loss of 60,000. Yeah, the company got 6 lakh by cancelling, and then the company is giving 6,60,000 worth of capital for free. Yeah, not for free, in replacement of that. So company is in loss of how much? 60,000. Yeah, there is a gap in the debit of 60,000. So that loss will go to capital reduction account, the balancing figure. While passing the journal entries, easily you can understand how much is being debited, how much is being credited, where is the gap. That gap has to always be filled by capital reduction, and that's 60,000, as you can see over here, balancing figure. Is that clear? That's how you have to pass this entry. Fine. Okay, I hope you have understood. Now let's just move on. Okay, see here, the C adjustment. Lenders to the company for 1,50,000 have agreed to convert their loan into share, and for this purpose they will be allotted 12,000 new preference shares of rupees 10 each and 12,000 new equity shares of rupees 2.5 each. Now easily you can understand what's happening over here. Just see in the balance sheet, we have loan over here, right? Long term borrowings loan, note number 3. See, 5,73,000 loan is there. So entire 5,73,000 is not being converted into shares. No, it's not like that. Here they have said lenders to the company for 1,50,000. Only 1,50,000 out of that is being converted. Okay, you have to understand all these things. Have agreed to convert their loan into shares. Okay, and for this purpose they will be allotted. So what will be given to them? 12,000 preference shares and 12,000 equity shares. Easily you can do this. Just debit the loan account by 1,50,000 and credit the create the new preference share capital and equity share capital. Yeah, give them new preference share capital, new preference shares and new equity shares. That's what you will do. Yeah, so see, loan account, see here, loan account debit 1,50,000. yeah, you have cancelled the liability of 1,50,000 and then you have credited the preference share capital by 1,20,000. How 1,20,000? They told 12,000, isn't it? So 12,000 into rupees 10, that's equal to 1,20,000. Fine. And then they said equity shares is 2.5. So 12,000, same only. The numbers of shares is same only. See here. Here 12,000 new equity shares. Yeah, of rupees 2.5 each. So 12,000 into 2.5, that's equal to 30,000, right? So see, loan account debit 1,50,000 to 5% preference share capital account 1,20,000 to equity share capital account 30,000. Clear? So now here, as you can see, it is equal. Yeah, the liability that is being cancelled over here is 1,50,000 and the capital, the shares which we have given in total is also of 1,50,000, 120 plus 30. So there is no loss, no gain over here. So nothing will go into capital reduction. Is that clear? Easy, simple now. Why did we debited the loan account? It's because the liability is being reduced, right? Yeah, and then we have credit the capitals because to issue the capital, to create the capital, what do we have to do? We have to credit it. Fine, that's how the capitals are increased in the books of accounts. Fine, now let's just move on to the D adjustment. See here, the next, the directors have agreed to subscribe in cash. Okay, in cash means, we are going to receive money in this. Okay, the directors have agreed to subscribe in cash for 40,000 new equity shares of rupees 2.5 each, in addition to any shares to be subscribed by them under A above. Okay, so they are saying apart from this, apart from the A, yeah, here also the existing shareholders have subscribed now under the right issue. So apart from that, here again the directors are subscribing to the new shares. Okay, how many? 40,000. So just simply just pass the fresh issue entry. Okay, in the study module you will find that they have passed two entries, bank account to share application and then share application to share capital, but you don't have to do all that. Just pass one entry, bank account to equity share capital. That's all is enough. Fine, just one is enough. So see here, that's what I have done. Bank account debit to equity share capital, right? We have received the money now. They have said subscribe in cash. Yeah, we are not just giving them just for free just like that. No, we are getting cash in return. Bank account debit to equity share capital 2.5. Okay, how many shares they said? They said 40,000. So let's calculate 40,000 shares into 2.5, that's equal to 1 lakh. Okay, so 1 lakh. So see, bank account to equity share capital 1 lakh, 1 lakh. Is that clear? Simple. And then the next adjustment, see here, of the cash received, yeah, E adjustment, of the cash received by the issue of new shares, 2 lakh is to be used to reduce the loan due by the company. Yeah, so 2 lakh we have to pay to the loan, right? So simply just make the payment. It's just a simple payment entry, that's all. So see here, loan account debit to bank account 2 lakh, 2 lakh. Is that clear? Simple. Moving on, then we have the F entry. See here, the equity share capital cancelled is to be applied. Now see, we have cancelled equity share capital and because of that we have capital reduction balance now, isn't it? Yes. So that balance we have to utilize, and that's what they are saying over here in this F point. The equity share capital cancelled is to be applied to write off the debit balance in profit and loss account. Yeah, we'll do that of course, and to write off 35,000 from the value of plant. Now see, this is what they are instructing us. Now see, plant is there of how much? Of 2,68,000, and they are saying just reduce 35,000 out of that. Just reduce 35,000. Okay, just write down by 35,000. Okay, we'll do that. We'll just credit the plant by 35,000. And then they are saying, see what else they are saying. This is new thing. See, they are saying that any balance remaining after doing these two things after doing these two things, that is writing off completely the debit balance of profit and loss and writing off the plant by 35,000, after doing this, if there is any balance left in what? In capital reduction. They're talking about capital reduction account. If there is any balance left after this in capital reduction account, then use that. It is to be used to write down the value of trademarks and goodwill. Now, if you see in the balance sheet, trademarks and goodwill are of how much? 3,18,000. You can see over here 3,18,000. And they are not saying us that write off this off completely. No. They are specifically telling us that whatever balance will be left at last in capital reduction, to that extent only you have to write off this trademarks and goodwill. Okay, that's what you have to do. So that's what we'll do. Okay, don't worry. So let's see how it will happen. It's really simple. What are you going to do first? What you always do first just check how much balance you have in capital reduction, right? So see, in the first entry here, capital reduction account was credited. So just put that in calculator, 7,12,500. Yeah, 7,12,500 plus, see if there is any other capital reduction. Yes, here there is a debit of capital reduction, which means minus, yeah, 60,000. So minus 60,000, that's equal to 6,52,500. This is the balance that is there till now in capital reduction. Just see if there is any more capital reduction, debits or credits. No, just two. Yeah, just two were there in this question. It was a simple, easy question, right? So what are you going to do now? This will be the final balance of capital reduction. This you have to utilize to write off all the losses. Now the question has told us first we have to write off completely the debit balance of profit and loss. Yeah, it's there in the question. If you see in the question, in the balance sheet here, debit balance of profit and loss is 4,51,000. Okay, so let's just use that. Okay, 6,52,500 minus 4,51,000 debit balance of profit and loss. I'm writing it off. So that's equal to 201,500, right? 2,01,500. Now from this we have to subtract what? Plant also by 35,000 they said. Now let's just check once again. Yeah, 35,000. So minus 35,000. So that's equal to 1,66,500. So this is the balance remaining after doing these two things in the capital reduction. This is the balance. 1,66,500 is remaining in the capital reduction account after writing off the debit balance in profit and loss and the plant by 35,000. So we have to use this remaining balance to write off what? To write off trademark and goodwill. Okay, so trademark and goodwill will be written down by how much? It will be written down by this amount, 1,66,500. That's the logic. Okay, so see the entry, capital reduction account. Yeah, this much balance was there. Now we saw 7,50,000 minus 60,000, 6,52,500. Now this we have to utilize. We have to write down this, write it off this completely, 4,51,000, and then plant 35,000, and then how much was left? 1,66,500. See here, 1,66,500 to trademarks and goodwill. You all know the journal entry now. Yes, capital reduction, credit balance was there of how much? 6,52,500. So here we are debiting it and completely closing the capital reduction, and then profit and loss has debit balance because it's a loss, so we are crediting it and cancelling it off. And then plant, we are decreasing the plant by 35,000, so we have to credit that, right? And trademarks and goodwill is also an asset, so to write it down, what you have to do, you have to credit it by how much? 1,66,500. Okay, see here, let me just show you the calculation once again. 6,52,500 minus 4,51,000 minus 35,000, that's equal to 1,66,500, right? So this is how you have to do it. Note here, here the question specifically asked to write down the value of trademark and goodwill by only the extent of the balance left in capital reduction account after writing off the debit balance of profit and loss completely and plant by 35,000. Okay, this is the new thing in this question. Fine. Yeah, so now the journal entries are over. Now let's just see how to prepare the balance sheet after the reconstruction. Okay, let's just go to the balance sheet. Now let's see how to prepare the balance sheet after the reconstruction. It's really simple. You all know. First, what do? We start off with the question. This is our base, and then we see the journal entries, what all adjustments have been done, the entire scheme of reconstruction, and give the effect of this scheme in the new balance sheet. Okay, that's what we do. So let's begin. See here, let me just show you the solution balance sheet, the balance sheet of Rebuild Limited. In the bracket you always need to write and reduced, yeah, as at 31st March 2021, right? So see here, share capital, note number 1, 10,60,000. How did we get this 10,60,000? Understand, go to notes to accounts, authorized capital. Now there was something regarding authorized capital also. See here, let's just understand that. Yeah, see here, the nominal capital as reduced is to be increased to 6,50,000 for preference share capital and 7,50,000 for equity share capital, right? So whatever authorized capital was there previously, from that we have to increase the preference share capital to 6,50,000 and equity share capital 7,50,000. So this is just a disclosure that we have to do over here in the notes to accounts. Yeah, just write directly authorized capital 6,50,000, 7,50,000, preference shares, equity shares, right? So how are we going to write the numbers? It's really simple, just divide. Okay, see, 6,50,000 divide by rupees 10. 10 is the face value now after the reconstruction, right? So that's equal to 65,000 preference shares. Okay, and then 7,50,000 is the new authorized capital of equity shares. So 7,50,000 divided by the new face value 2.5. So that's equal to 3 lakh equity shares. Okay, this is the authorized capital you have done. In total that's 14 lakhs. Okay, so authorized capital or the nominal capital thing is over. Now come to issued, subscribed and paid up. How it's 10,60,000. Let's understand how are we getting 10,60,000 over here. It's really simple, just see the journal entries. Okay, let's just first talk about equity share capital. Okay, so see, equity share capital here we created in the first entry 37,500, right? 37,500 plus then we issued here also right issue 1,12,500 plus 1,12,500, and then here also we gave equity shares to preference shareholders 1,80,000, right, plus 1,80,000, and then here to the loan holders also we gave equity share capital, how much? 30,000. So plus 30,000, that's equal to 3,60,000. Is there anything else? Yes, here also, yeah, we have issued shares to directors also, right, in this fifth entry. So that's 1 lakh, so plus 1 lakh. Okay, so that's equal to 4,60,000 equity share capital. Is there any more? No, that's all, right? So 4,60,000 is the new equity share capital. Yeah, so see here, 4,60,000 in notes to accounts, you can see. Yeah, divide this by 2.5, you will get the numbers. The number is 1 lakh, sorry, what did I do? 4,60,000 divided by 2.5, that's equal to 1,84,000. Okay, there is a mistake over here. Here it should be 1,84,000. Fine. Yeah, you can just check 1,80,000 into 2.5, it's equal to 4,50,000. So here there is a mistake. This should be 1,84,000. Okay, fine. Moving on, then I will correct it, okay, afterwards. Yeah, then we have to see the preference shares, right? So preference share capital, here it is 6 lakh. How is it 6 lakhs? Let's see. In the journal entries you can see over here, preference share capital, first it was 4,80,000. Yeah, I mean previously it was something else, right? It was 6 lakh or something. Then what happened? Now also it's 6 lakh. Yeah, now also it's 6 lakh. Yeah, after the reconstruction also it's 6 lakh only. So preference share capital is 4,80,000 here, and then we issued to loan holders also 1,20,000. So 4,80,000 plus 1,20,000, 480, yeah, 4,80,000 plus 1,20,000, that's equal to 6 lakhs only. Okay, yeah, 6 lakhs only. So see here, 6 lakhs, 6 lakh divided by 10, that's equal to 60,000 preference shares. Clear? Easy. Let me just fix this over here only. This is 1,84,000. Yeah, 4,60,000 divided by 2.5, that's equal to 1,84,000. Okay, this is 1,84,000. Fine. And then what else? Yeah, share capital is over. 4,60,000 plus 6 lakh, that's 10,60,000. So here it's 10,60,000. Fine. And then non-current liabilities, long-term borrowings. In long-term borrowings, what did we have? In long-term borrowings we had only loan. So is there any changes in loan? Yes. Yeah, what happened in loan? Understand, what did we do in loan? First, loan has been decreased by 1,50,000 and then loan has been paid off by 2 lakhs. Yeah, here the shares were given, but still it was decreased now, liability was reduced, and here it was reduced by 2 lakhs, right? So previously loan was how much? Loan was of 5,73,000. So take that 5,73,000 minus 1,50,000 minus 2 lakhs payment that we did, right? So that's equal to 2,23,000. Okay, 2,23,000. So let me just see long term in the new balance sheet, long term borrowings 2,23,000. Okay, 2,23,000. Okay, this is how you have to do the calculation. Let me just write that, right? 5,73,000 minus first 1,50,000 and then minus 2 lakhs, right? All right, yes. And then current liabilities, trade payables was 2,07,000 and 35,000. That's same only. There is no change at all in trade payables and other current liabilities. So it's same only. So 10,60,000 plus 2,23,000 plus 2,07,000 plus 35,000. That's equal to 15,25,000. And then come to the asset section. Here, PPE, has there been any change in PPE? Yes, we have reduced the plant by 35,000. So that you have to consider. Yes, 6,68,000. There was building. There is no change in building. The same only 4 lakh. But in plant, we have made a change. We have reduced the plant by 35,000. So from 2,68,000, we have reduced 35 out of this. So minus 35. So that's equal to 2,33,000. Yeah. See in the new balance sheet, building is same only 4 lakh, but plant has been reduced. Yeah. It has been reduced by 35,000. So it has become 2,33,000. 6,33,000 in total. So see 6,33,000. Clear? Easy. And then in intangible assets, what has happened? Have we written off the intangible assets completely? No. What have we done? We have just reduced that balancing amount, right? We have just reduced the trademarks and goodwill by 1,66,500. Yes. So that's what we are going to consider over here. See, trademarks and goodwill in the question were how much? In the question they were 3,18,000. Yeah. So see, trademarks and goodwill in the notes, note number 3. 3,18,000 minus 1 lakh. How much have we reduced? 1,66,500. 1,66,500. Yes. 3,18,000 minus 1,66,500. That's equal to 1,51,500. Yeah, 1,51,500. Correct. Fine. Okay, so non-current assets are over, and then come to the current assets. Inventories, trade receivables, there is no change at all. Yeah, inventories and trade receivables were 4 lakh and 3,28,000. So it's same as it is. There has been no change under the scheme of reconstruction. Yeah, so it's same. But we have cash now. Previously we didn't have cash, right? Now we have cash. Okay, so how are we going to calculate the cash? It's really simple. See, first we got the cash in bank from the right issue that we did. Yeah, 3 for everyone. 1,12,500. So just take that in the calculator. 1,12,500 we got first. Okay, plus 1,12,500. And then what happened? We got 1 lakh from the directors. The fresh issue we did to directors now. From there also we got 1 lakh. So plus 1 lakh. And then what happened? So we had 2,12,500. So have we received any more money in the bank? No. We have made a payment to loan holders, right, of 2 lakhs. So we have to subtract that. Minus 2 lakhs because we need final amount now. So that's equal to 12,500. So this is the cash that we have right now in the bank account at last. Okay, so 12,500. So we have to take that. See in the new balance sheet, cash and cash equivalents 12,500. Yeah, see 12,500. We received from right issue 1,12,500, and then from directors we received 1 lakh fresh issue. Yeah, because of the fresh issue. And then we paid to loan holders 2 lakhs. So that's 12,500 we have right now. Fine. Yes. So that's how you have to do it. It's really simple. Yeah. So this is the balance sheet. So 6,33,000. Let's just add it up and see if you want. 6,33,000 plus 1,51,500 plus 4 lakhs plus 3,28,000 plus 12,500, that's equal to 15,25,000. Let's see in the liabilities, equity and liabilities also. 10,60,000 share capital plus 2,23,000 loan, yeah, long-term borrowings, plus trade payables 2,07,000 plus other current liabilities 35,000, that's equal to 15,25,000. Clear? Easy, right? So this is how you have to do it. It's really simple, it's not difficult. All you have to do is just pass the correct journal entries, and you will only be able to pass the correct journal entries only if you know the technical language which is used over here. And how your technical language will get better? Just by practicing lots and lots of these problems. Okay, yes, so that's all for this video. Okay, I hope you have understood each and everything. If you haven't, then please comment down below, ask your doubts, and you can also direct message me on Instagram. Okay, send the photo and ask the doubt directly. Okay, right, so that's all for this video. Okay, see you in the next video. Bye.